Good morning, everyone. You're all very welcome to our Monday market preview for the week ahead. Of course, Friday, the backdrop of NFP. Today, we do have a number of bank holidays in various markets, including the US, Canada, and Japan overnight in the Asian session. So not too much in terms of liquidity, in terms of volume today, as per the calendar. But broadly speaking, we do obviously have to factor in the market movements in the wake of Friday's NFP non-farm payroll figures, and of course looking ahead to next week, when we will obviously be starting with Q3 earnings season, where all of the major Wall Street banks will be coming out with their expectations in terms of the revised EPS, earnings per share, and all of the other associated kind of economic data within their financial reporting. So I suppose it's going to be a busy couple of weeks. Of course, September, as we know, it was a hugely volatile week in the broader month, should I say. But it's of course now setting the tone for Q4 and for the end of the fiscal year of 2022 as well. So we're obviously looking at that very, very closely. Now, as we alluded to, Columbus Day in the States, there is obviously a bank holiday today. So we're not expecting that much in terms of volatility and volume. And traditionally speaking, the Monday after the NFP in a normal circumstance does prove to have very little trading volume broadly. So today we do obviously have to factor in the holidays as well. Tomorrow, from an economic outlook or an economic calendar perspective, we do have a raft and a number of different central bank speakers on the wires tomorrow. We've got a number in Europe between Lane's actually speaking multiple times tomorrow. And we do have a number of Fed speakers as well. We've got Harker, Mester, we've got Cunliffe in the Bank of England. We do have Ellis in Australia in the RBA. And of course, we do have Jordan, who is chairman of the Swiss National Bank as well. So we've got multiple different influential members on the wires tomorrow. So obviously important to keep an eye on that as well. And of course, then setting the tone for what was, as we know it, a very, very choppy Friday, broadly speaking. Now, if we go back to Friday's economic calendar, just to, I suppose, recap on the data, obviously huge volatility. We had overall a fairly strong number in terms of the actual NFP figure. Now, the consensus was that, yes, the NFP figure, normally speaking, if it's stronger, you should generally tend to see the stock markets rally. However, as we've seen, it's not always the case where markets will go in a specific direction off a specific piece of data, and you do have to factor in the wider economics at scale here. Now, on Friday, we had overall a fairly strong jobs report, and generally speaking, in normalized markets, that would mean that it would be good for the equity markets. Now, the only reason why the markets didn't rally on Friday was because that the mandate by the Fed has always been full employment and stable prices. As a result, on Friday, the unemployment rate actually decreased. So I have it here as well. The labor participation rate held strong. The average early earnings held strong. The non-farm payrolls actually was above expectation, and the overall unemployment rate actually dropped. So if I guide you to the figures here, you can actually see how it's actually decreasing. Now, normally speaking, the outlook is that, right, stronger economy, stronger jobs market means good for the indices, good for the stock markets. Generally speaking, that is correct. However, Friday's backdrop has really been all about the Fed's mandate lately, that their sole goal objective is, as we said, full employment, stable prices. Now, the back of the full employment means that the Fed has even more capacity now to increase its rates and continue raising its rates for longer. Because in their eyes, as long as the jobs market, the employment sector holds up, broadly speaking, they're happy to continue pushing these rates higher. Now, of course, it turns out that actually the good news from the jobs report is actually bad news for the stock markets as a result, because obviously that gives the Fed more comfort in the belief that if they continue raising rates, the jobs market, broadly speaking, is still going to hold up fairly well. Unfortunately for the US economy and many other economies, the employment sector, although it's probably one of the most important elements, is probably the only shining light when you look at any of these pieces of economic data. When you look at GDP, at the overall growth, when you look at retail sales, PMIs, ISMs, any of these other data figures over the last 6 months, they've all been decreasing continuously. So we also have to factor that into consideration, that yes, the employment figures are obviously holding strong, but that's given a little bit more I suppose, leeway for the Fed to continue raising rates. And of course, then in the backdrop of Friday, a lot of surveys was released to say that 75 basis points is almost guaranteed now for the next Fed rate again. And of course, higher interest rates is a negative for stock markets as well. So it's just important to understand, right? If you're looking at this and you're thinking, well, the indices should rally because of the numbers, yes, but you also have to factor the additional, I suppose, circumstances at play here. And I just wanted to give people a little bit of information on that as well. So that's kind of the backdrop on the NFP figures on Friday. So I suppose in our eyes now, it becomes really a case of looking at the markets in the broader sense. So this morning, as we look at the markets, obviously not too much happening this morning, broadly speaking. We had seen the dollar obviously poke up. So Tuesday, Wednesday, we found that midweek reversal last week, continued going all the way through into the close of the week, where the yields closed up at almost 3.9%. And the dollar continued pushing strongly as well. So we had that very much that V-shaped return, where we had a very, very stronger move in the equities and stock markets Monday and Tuesday. We had that midweek reversal or reaction. And of course, then we saw that cyclical reversion, as we've seen so often in the last number of weeks, out of one asset class into another. And we're starting to see the dynamics at play there very, very quickly. So obviously then, with the stronger dollar into the end of the week, we've seen euro dollar become on the back foot again, from what was a very, very interesting area up at parity. And obviously the cable has continued to sell off over the last number of days. So euro dollar from parity has rejected one. It's come all the way back down to the 97. So of course, obviously with the stronger dollar, it means euro USD, should I say, has continued to drift lower, and just being conscious of that. The GBP USD, broadly speaking, came all the way back up into this region here around 115. Obviously that was the inverted V shape in terms of this up and subsequent reversal back into the kind of the 110s, 111s area. And of course, that's off the back of this much stronger dollar since, I suppose, last Tuesday, last Wednesday. We did obviously talk about that Thursday and Friday. And again, similarly with gold. This was a very, very clean play on gold. Obviously flagged beautifully back up into this region, rejected the order blocks in around the 1720s, 1728s. And we had that double mitigation. So we had the initial impulse, we had the rejection, we flagged back up again, clear bearish engulfing. And that, I suppose, even there at 1715 was your telltale sign that this was going to continue moving lower. And of course, since then, through Friday into the beginning of this week, gold markets have come back lower, back into the 1670, 1680 area as we approach the early parts of this week, and of course back into this key level, which of course, if we go up to the weekly charts, you can see it here very, very quickly. So weekly rejections, flags back up. It doesn't necessarily stop here at this key level, flags all the way back up into the shorter term order block area, with this bearish trend currently intact. And now, of course, markets is trying to break back underneath the 1675s as well. So it's very interesting now how the dynamics are at play now here, particularly when you look at the price action on gold, for example. So that then brings in the indices, just to finish this morning's video. Of course, we had that peak last week, Tuesday, very, very quick unwind, broke through the lows, flagged all the way back down. And I suppose now it's a case of, can the markets show some sort of resilience? This was the area that I did quote last week to keep an eye on, 3600, 3650. We did get back into it. Now it's a case of, is the markets going to try and assimilate some sort of approach where we can start to grind higher again from this region? Or are we looking at potential taking of the lows here at 3550, 3560 area? So definitely worth keeping an eye on the price action here. If we look at even S&Ps in the order block, consolidation, took the lows in liquidity, took the highs in liquidity, flagged back down into this region here now. I suspect if we use the Fibonacci's as well, just as an additional charting tool, you can see here very, very quickly into the discount zone is where we currently stand. So I suppose from that, obviously conscious of the price action, it could very much continue drifting lower. And of course, the indices to continue drifting lower would be off the backdrop that we see the dollar ultimately continue rising, and of course retest these current highs here, which is roughly speaking around 114.50 to this 114.80 area. So worth keeping an eye on that. Of course, in the Nasdaq, very, very similar scenario. If we look at the Nasdaq quickly, it did all three Identical structure, consolidation, broke the lows, flagged up, taking liquidity here all the way back down into this region here. And of course, this area around 11,000 to, I suppose, 10,850 is what I would be kind of telling people to be kind of closely watching this week to see how does the markets react. Is there any sort of reaction off of this area, or are we going to continue the sentiment of the underlying fundamentals, stronger dollar, weaker risk assets, and basically new lows, new lower highs, new lower lows to follow. So just kind of keeping an eye on that as best as possible is the recommendation. Of course, you can see here now, the liquidity areas have been quite clean. Obviously, the initial hunt into the key area broke the highs, took the liquidity of this consolidation region here, which was quite prominent. Of course, we've topped out. And then, of course, on Friday, off the back of the NFP, this complete sell-off, unwind, back into this local area now. And now it's a case of how do we get some sentiment to start the week. Now, last but not least is the Dow Jones. And as we look at the Dow Jones, it was probably the best performing of the three. So in terms of the sell-off, it was less, although as heavy as it wasn't just as bad as the other two. So again, similar scenario, consolidation, took the lows, flagged up, taking highs, broke through this structure here. Once we kind of broke under 29.8, I did kind of look at this area here between kind of 29.3 being the area of interest. And of course, again, that's exactly what's playing out. So from our perspective now, you can see that as well, flagging back in. And of course, discount zone has been hit 71.78. And of course, we are trading just marginally under 61.8. So I do think now it's a case of watching this, because this could be the next phase up. Obviously, depending on market orders, liquidity, stop hunting, etc. But definitely worth keeping an eye on this from a smart money perspective as well. And of course, then FTSE, very, very clean. So that sell-off was undone last week. So we obviously had that first wave reload back into 7,500. Massive sell-off pretty much through the last 2 weeks of September into these lows here for month end. We did get that relief rally. Of course, again, similar to the US asset classes, taking out the short-term liquidity. So this 7,000 level, if I just remove that just for a moment, you can actually see very, very clearly how all of these kind of wick highs, all of this liquidity here had been taken out. Why? Because the markets got the move directly above the area of liquidity. So you can see here, area of liquidity taken, and then all of a sudden we get the unwind. We get the pullback into this region. So from our perspective now, I suppose as traders, it's worth being mindful of this, watching the areas of consideration. Yes, you could very easily break 6,800, but we've seen how the markets have reacted at this 6,800 level for the last, I suppose if you want to break it up, nearly 18 months, 15 months. Every time we've come into 6,800, there's been a strong reaction off it. It's always about the battle of sentiment, momentum, supply and demand, being able to break down the battle between the buyers and sellers on a constant basis. And again, that's whether it's shorter time frames or broader time frames. So I suppose from here now, it just becomes a case of watching this area of interest. We did gap margin lower this morning. However, we are trading, I suppose, marginally on the back foot, but not too much in consideration to, I suppose, the sell-off on Friday. And again, similar to that, if we were to look at it, you're probably looking at this saying now there's a little bit more to go. Me personally, I tend to look for, from looking at Fibonacci's, I tend to look for a little bit more value rather than the 50, because the 50 isn't actually a true Fibonacci level. It's merely the halfway point of the retracement. So it's just to be kind of wary of that as well. So that's the FTSE. And of course, then lastly on the DAX, DAX is definitely the weakest of all indices, in my opinion, at this moment in time. We obviously had that breakthrough 12.5. We flagged back up. I did look to come a little bit higher, to be honest. I suppose on the daily, I look at this and I see this area here at 12,750. Didn't quite get there, got to about 12.7. And of course, we had that similar scenario. We had that top price action flags back down. Didn't quite get to this area here, so there's maybe still a little bit more to come on the downside. However, obviously the DAX has been on a decent run up this morning since the open. So DAX at the minute is I suppose, from last night's gap, is trading up about 60, 70 points from the session lows of Asia and pre-market this morning, pretty much the London Open. It's up a modest 150 points. So it's got a nice rally from the open this morning. But again, just waiting to see kind of how these markets will react, because we've obviously got the top formation. We've broke back underneath this 12.5 for a period. We sold off, obviously NFP being the catalyst for that, finding short-term bottoms. We're now getting a counter trend short-term rally. My expectation is, do we get 12.4 for another reload into the lows? I suppose time will tell. And I suppose it's just all about kind of being wary of that as well, being conscious of, I suppose, the structures that's at play within these markets as well. All right. So that's pretty much it for the Monday market preview, everyone. I suppose it's just a case of setting the tone out for the week. Obviously, the bank holidays today, backdrop of NFP on Monday, and of course, getting ready for what will be obviously earnings season next week. Now, on Wednesday, we will obviously be looking at another videos throughout the week, but Wednesday we do have more important figures in the US. Of course, if we just dial out to this week, let me just filter the economic calendar. We actually do have some pretty big figures in the US this week, and for some reason my calendar isn't working, but on Wednesday we do have the CPI figures. Of course, that'll be of paramount interest to see, are we starting to see this continual abating in the interest rates? It's going to come down, but how long is it going to take? Is it going to be a significant drop in inflation, or are we going to get an upside surprise? Last month, expectations was we look for it to be a lot more vicious. In terms of the downside pullback, it turned out that the weakening in inflation wasn't as I suppose as prominent as people expected. And of course, then what happened? It was a buy the rumor, sell the fact scenario, and the indices completely sold off. So you do obviously have to be conscious of that as well. All right, have a great week, everyone, and we'll see you all later.